Okay, in Chapter 3, we're going to be focusing on planning the audit, types of audit tests, and how we determine materiality. So you could take a look at the 12 learning objectives that are listed in the beginning of your chapter. And we're going to start with the first one. We're going to be looking at the phases of an audit that relate to audit planning. The first is client acceptance or continuance. What does it take to even accept a client for audit? Some preliminary engagement activities, and then planning the audit. So that's what we're focusing on in the objectives of the chapter. So when you're looking at a prospective client, some of the things, if it's a brand new client, never been audited before, you want to make sure you obtain and review financial information from that client. You need to check on the client's integrity, meaning what's their reputation in the business with their creditors, with customers, with suppliers. You want to inquire around. You want to take a look and see if they have any unusual business dealings or if there's any significant audit risks. And we talked about audit risk. Of course, we want to make sure that the accounting firm is independent to the client. So we'll be talking independence. What is independence in much more detail, but we want to make sure of that. Determine if the firm has the knowledge and technical skills to even conduct the audit. And determine if acceptance violates any of our regulatory agency requirements. So Sarbanes-Oxley, the Public Company Accounting Oversight Board codes, or the Code of Professional Conduct. If it's a continuing client, we want to make sure that every year or so we evaluate our client retention. Should we keep this client? Is there any issues going on with them? And so near every audit completion or after a significant event, conflicts over accounting and auditing issues should be looked at and resolved, and any dispute over fees. So what we want to be careful of, and we could hurt our independence, is if we have a client owe us money from last year's audit, should we be doing this year's audit? And usually accounting firms make sure all audit fees are paid before they issue an audit from the for the current year. So we have to look at these to see, is it worth keeping this client? Before we get into the preliminary engagements, there isn't a slide on this, but what if this client, this prospective client, was actually audited by someone in the past? And they talk a lot about that in the beginning of the chapter. So I just want to discuss it. It's very important that we inquire of the predecessor auditor. Okay, and the predecessor auditor is fully responsible for acknowledging and responding back. We need to ask the client if we can look at the prior information the auditor has on them. Now, if there's no issues with this prospective client, they should have no issues with us looking at it. But if they do, you may want to reconsider taking this company on as an audit client. Once we accept them, then we ask to really look at the work papers of the predecessor auditor so that we can have a beginning starting point for our audit, beginning balances in accounts. You want to make sure that, sorry, I got interrupted, that you've reviewed all of the information from the predecessor auditor. And a lot of times we will take copies of the work papers from the predecessor auditor to bring with us and to make sure we examine them and use them in our current audit. Not to rely on them, but to have them as information. And let's see, on page 70 of your book, we take a look at those items to assess if we should accept a client, as well as table 3-1. So a brand new client, never been audited before, some of the steps and questions we have to ask before we accept that client, if they had a predecessor auditor, some of the responsibilities that we have and the predecessor auditor has, and what we do before we start our work. And if it's a current client that's continuing to be a client, what we need to do to assess if we should continue them into the future. So once we complete that, now we could get into our preliminary engagement activities. We need to determine the audit engagement team. Who should be on the team to conduct the audit? Is there anybody with special technical training, proficiencies that are needed? And we have to assess compliance with ethical and independence requirements. So, are we independent with respect to the client? And usually, I know that's not what's on this slide, but usually the members of the audit team will complete independence questionnaires each year. The partner will review them to verify that there is independence indeed. And this takes me back to some of my audit days. It just so happened I was a brand new accountant, first year auditing. I was auditing a local school district, and I was auditing their payroll. And I was at my parents' house, and I said, oh, I'm on an audit at a school district. I didn't talk about the specifics of it, but it was public information that we were the auditors for that school district. And my father at the time was working at another school district. He was the department manager of their computer programming. And it just so happened that he did programming on the payroll for the client I was auditing. And because of that, you think, so what? There was an independence issue. Because I, with my father, could have compromised the files there. Or, it just, in the appearance itself, since we both he had access into them and I was auditing them, I lacked independence on that audit. So it's very important, and it was a wonderful day when I found out I did, because I walked away from it and I said, woohoo, because I wasn't too much of an auditor. I did it, but it wasn't my favorite thing to do. So that's just one example. And like I said, it gets very specific with how we determine independence. So for now, if you're going, what is that? What is that? Don't worry about it. You're going to learn about it in detail. But know that if you don't have independence, you cannot be on that audit team. And it has to be determined and reviewed. There's an independence issue, again, if there's unpaid audit fees in accounts receivable, because now you're taking on a creditor function. So there's many different things that could affect our independence, and they talk about one or two other issues in your book, so take a read on it. Once we determine the team and determine that they have independence to the company they're about to audit, now we could get and establish an understanding with the entity. Now we can start the ball rolling. So we establish the terms of the engagement in an engagement letter. And also, how will we use the work of any internal auditors? And then we're going to define the role of the audit committee. An engagement letter is beyond important, and it's on page 73, 74, 75. That is the engagement letter between the auditors and Earthware Clothers, the company we're going to be working in. Everything's spelled out in the engagement letter. It's the contract. It's the arrangement between the auditor and the entity, and it defines the responsibilities of both, including any specialists that need to be used, any limitation on liability to the auditor, and any additional regulatory services necessary. Now it says, who signs the audit report? Well, the partner of the audit firm and the audit committee chairperson. So let's get into the nitty-gritty again. The engagement letter formalizes the arrangement. In addition to the items mentioned in the sample engagement letter, the other items I was talking about. So once you have that engagement letter signed by both parties, now you can also define how are we going to evaluate and rely on internal audit function. If you're auditing a company, and we're taking our audit class from the perspective you are auditing a public company, one that's traded on a stock exchange. Most, if not all, will have an internal audit function, meaning they have employees of the company who audit the company. They don't need to be independent because they're not writing reports. They are actually looking at the processes of the company, making sure that they're good, making sure that people are following them. They are checking that the accounting is being done correctly. So whether the organizational status of the internal audit function, including the function's authority and accountability, this is what we're looking at, supports the ability of the function to be free of bias, conflict of interest, or undue influence of others to override professional judgments. So if those things are present, we can't rely on it. But if we feel those things are not present, the independent auditor can rely on some of those functions or tasks internal audit did. So whether the internal audit function is free of conflicting responsibilities must be defined. Do they have managerial or operational duties or responsibilities that are outside of the internal audit function? So if they're responsible, if they have a managerial position or an operational duty and they internal audit it, that's like watching yourself. Can you really rely on that? Okay, so they almost have to be independent of the other functions of the company for it to be reliable. We're also looking to see if the audit committee oversees employment decisions related to the IAF. Are they hiring them? Because now you have somebody outside the company's operations or management hiring the internal audit function employees. That will signify independence. Now remember, the audit committee is a subgroup of the board of directors, and we'll talk more about them in a few minutes. Whether there's any constraints or restrictions placed on the internal audit by management or the audit committee. Are they stopping them from doing their job properly? If the answer is yes, we may not be able to rely on their information. Whether the internal auditors are members of professional bodies and their memberships obligate their compliance with professional standards to be objective, or whether their internal policies achieve the same objectives. So, are they following a good ethical set of rules with regards to their job and how they audit? And if they are, that may signify we can use their work. So we're looking for all these things in that internal audit function. Is there competence of the auditors? Is it adequately and appropriately resourced relative to the size of the company? Whether it's established policies for hiring, training, and assigning internal auditors. So let's look at the internal audit department itself. Do they have adequate technical training and proficiency in auditing? If they do, we could probably rely on their information. Whether the internal auditors possess the required knowledge related to that entity's financial reporting. And whether the internal auditors are members of those professional bodies that oblige them to comply, again, with relevant professional standards and continuing professional development. So they're still going to school, get the most updated information about auditing and GAAP. So you could see as we're going through these different items, is that internal auditor really an auditor who just gets their paycheck from the company? Are they systematic and do they take a disciplined approach? Okay, so let's look at the existence if there is even any, adequacy and use of documented audit procedures or guidance covering such areas. Are they assessing risk? Do they have work programs? Do they document it and report it? Whether the IAF has appropriate quality control policies and procedures. Okay, so these are the things that are all being taken into account. We went into this into a real lot of detail with internal audit, but it's all necessary because why reinvent the wheel? If the internal audit function is assessed to be a good working unit that is truly auditing the company, let's use some of their work. Why do it again and then charge the client for it when they're already paying an employee to do that work and they're doing it like we would as an independent auditor? The Audit Committee, again, subcommittee of the Board of Directors, no specific requirements for an audit committee if it's a privately held company. But if it's publicly held, Sarbanes-Oxley requires the following: members of Board of Directors and they're independent. So the Audit Committee must be members of the Board of Directors and they're independent in regards to the company. They're directly responsible for overseeing the work of the registered public accounting firm employed by the company. So they're watching the auditor. They must pre-approve all audit and non-audit services that the auditor provides to the company. So it has to be documented. They have to establish procedures to follow if there are complaints. And they have the authority to hire, engage independent counsel when they need to. Okay, so they are a separate part of the Board of Directors, which is hired. Remember, the Board of Directors are voted in by the shareholders. They are not part of the management of the company. And they are doing all these things for the company. Required by SOX. So, once we have an engagement letter, see how much we could rely on internal audit function, and understand the role of the audit committee and make sure that they're on board with that. Now we could start the planning of the audit. This is where the auditor is going to develop an overall audit strategy. What do we have to accomplish? It helps the auditor to determine what resources are needed to perform the audit. Do we need a specialist? How many employees do we need on the audit team? Okay, so it's a strategy. The audit plan is the detailed. Here's how we're going to achieve that strategy. So basically, the audit plan should consider how to conduct the engagement so that we get what we need, it's effective, and we do it with the least resources. It's efficient. So here's what we want to achieve. Here's how we're going to do it. Let's make sure that we do it effectively so we get an answer and we do it with the least amount of resources efficiently. That's our focus. So when we're preparing this plan, the auditor should be guided by the results of what the results were from their client acceptance continuance process. What procedures performed were done to gain the understanding of the entity. And what were the results of their preliminary engagement activities. Part of the planning process also should be assessing business risk. Okay, what kind of things could occur just because of the nature of the business? What kind of risk is associated with this type of business? And would those business risks cause material misstatements in the financial statements? Okay, so these are things they're looking at. They have to establish materiality levels, which we go over in detail later on in the chapter. It's our last part of the chapter. What is an okay misstatement on the financial statements? People make mistakes. We're all human beings. Things are written down wrong. What's an okay number? We can't fix every mistake, because we don't look at every error. We also have to consider how our audit in the planning process should account for multi-locations of the business. How should we conduct our audit? So for instance, if you have a company with 3 warehouses of inventory, how are we going to audit those locations? Okay, and what kind of material misstatement could occur because there's multi-locations? Do we need specialists? Sometimes we do. We're not all experts in all the fields we look at. We may need a tax expert. We may need an IT expert, someone in finance. So who do we need? How much are they going to cost? We have to look to see, are there any violations of laws or regulations? And how would those impact? Do we see anything yet? How will they impact the financial statements? And what we're focusing on, and we're going to talk more about it in Chapter 4, are direct and material effects. So illegal activities that have a direct and material effect on the financial statements. Okay, and they talk about those in your book a little bit. How do they affect our audit process, our audit plan? What other kind of, who are related parties to the company? And if you look on page 80, auditors should attempt to identify all related parties. Why? Related parties, especially if there's any kind of transactions between the company and a party that's considered related, which we'll define, has to be looked at because you want to make sure any transaction is done as if they were an independent party. They weren't related. When you're related, you tend to not perform a transaction. For instance, I walk in the store, you know you're working the store. You know I'm your teacher. Are we related? No. In the eyes of accounting, no, we're not related. But let's say I buy a few things and you give me your discount. Okay? That is what we're talking about there, related party. You give a break to one another. Where if I walked in and I wasn't your teacher, you would just ring out the register and that would be it. And I don't say do that, but I'm just saying that's the kind of transactions we're looking for in here. Who are those related parties? Are there any kind of transactions between the two that might cause a material misstatement if they're not being handled correctly? And some ways to find related parties are read the minutes of the board of directors. Look for conflict of interest statements. Financial and reporting information provided to creditors, investors, and regulators. Look at contracts or agreements representing significant, unusual transactions, which you would all do during your audit process anyway. But you've got to identify those individuals and companies and make sure that what is happening is a true business transaction. You want to document, I consider additional value added services. You should look for opportunities, this is part of your selling, to recommend additional services that could be performed for the client if the audit company could do it. And then you should document. Everything must be written down or in a computer. It has to be somewhere. The strategy, the plan, and prepare audit programs. Okay. Now on page 82 is an example of an audit program. An audit programs focus in on specific areas. Now, I'm sorry, I didn't realize we were going through each one on its own slide. But let's take a look at them. It's good to review one more time. So we're assessing business risk, to understand the entity's business, and to identify financial accounts likely to contain errors. We establish materiality. We establish it overall for the whole company. And then we also determine what's called tolerable misstatement for a specific account or disclosure. Talk more about that. The multi-locations we talked about. How much attention do we devote to each location? Do we need specialists? We've talked about that. What if there's violation of laws? Remember, it's direct and material. We consider laws and regulations as part of audit. Material and indirect, be aware of what have occurred, investigate if brought to your attention, but if it does not affect the financial statements materially, we're not looking at that. We are not, by the way, looking for illegal acts. We're looking to see that the financial statements are fairly presented. So an investigation by a government agency and enforcement proceedings or payment of unusual fines or penalties could signify we have an issue here. Large payments for unspecified services to consultants, affiliates, or employees can also signify a violation of a law. Sales commissions to an agent that appear excessive. Large payments in cash or bank cashier's checks. So these are just some of the items you may be looking for. Unexplained payments to government officials. That's a big red flag. Failure to file a tax return or pay government duties or fees. Related party, again. Here's some examples. Affiliates of the enterprise. So you own another company. Your company owns more than 50% of another company. Entities using the equity method to account for investments. Again, that's what we're talking about. You own more than 50%, even 20% of the voting stock of another company. And you saw all this in intermediate accounting and advanced accounting. So this should be a little familiar to you. Trust for the benefit of employees. So the trust is considered a related party. The owners are considered related parties, so are management. Immediate families of the owners and management are considered related parties, or any other party that has significant influence on the company. And there's how we identify them. We went through that list. Again, it is in your book. I think it was like on page 80 or 81. Here are those additional value-added services. What else could we do for this company that we aren't doing now? Maybe do some tax planning for them. Maybe we could do some system design and integration for them if they're lacking that. Do some internal reporting, assess risk, do some benchmarking for them, do some electronic commerce. So auditors who audit public companies are limited to what they can do, but auditors who audit private companies are not. Okay, so once we go through that, like we said, we document the audit strategy, plan, and audit programs. Now, we document overall, as we said, strategy and audit plan, which involves documenting the decisions about the auditor, about the audit. The auditor documents how the entity is managing its risk via internal control processes. So it looks at how the company performs tasks. What are the procedures in place to protect the assets? What risks are associated with that? That's internal control. And the effects of risk and controls on the planned audit procedures. And those items will define the nature, so what we have to do, when we have to do it, and how much we have to do. Nature, timing, and extent. This is all during the planning process. So auditors ensure they've addressed all that risk by documenting it and documenting the link from the entity's business, objectives, and strategy to the audit plan. The auditor's preliminary decision concerning control risk determines the level of testing they do. The level of testing affects the auditor's substantive tests of the account's balances and transactions. So what happens is we go, okay, how much risk is there in the internal control of the company? The more risk there is, the more testing of account balances and the transactions inside of the account we would have to do to feel confident that the account balance is correct. The less risk, so if they have great internal controls and people are following them, there's less risk. So less audit sampling and testing need to be done to make sure those account balances and transactions are correct. That's what they're talking about there. And that's what this semester is about, determining that. So take a look at this program. Here's the business objectives and strategies. Increase market share. So this is the businesses. They want to increase market share through sales at new international locations. During the current year, websites were developed for these countries. What's the risk? Restrictive trade laws may affect sales tactics. Strong consumer protection laws in European countries, and then political instability in less developed countries. What accounts do we need to look at? Revenue. We need to determine if it's accurate and valued properly. So is it correct in there? And is the correct amount being reported? What kind of audit risk is there? So what's the risk of that account? It's overstated due to pricing issues, or it's understated due to failure to properly track returns in new locations. So these are all things, you're not expected to know that. Okay, that's all part of the process you learn as an auditor. That's why we start out at the bottom. And then we slowly move up into, we start as a staff, then we go into like a senior position, then a manager position, and then partner. So this EWC has installed a special group. Here's the controls that they have to track compliance with local and international laws. So that is how they're trying to prevent any kind of risk from occurring. EWC has placed more frequent review of returns in new locations. Okay, so knowing all that, how do we plan our audit? We'll observe and test the policies and procedures that they talk about there. Let's make sure that they've installed a special group. Let's make sure that they're tracking compliance with local and international laws. And if they're doing that, we'll have lower audit risk, okay, and we could rely more on the internal controls. The second one, we're going to extend the audit work of the company's return tracking with emphasis on new locations. So we're going to do some audit work on these new locations and make sure they are reviewing more frequently returns in those new locations. If they are, then we can rely on that work. And that's why when we say we're relying on internal controls, what procedures are they doing to alleviate the risk involved with that business strategy and objective? Another business risk related to this strategy is foreign currency risks. Back in advanced accounting, you learned that foreign currency, there's a lot of risk when you're dealing with that. You may be getting paid in foreign currency in a month or two, and there's a risk of it going up or down in value. So the account assertions, gains, that's supposed to be losses, not tosses, from currency hedging, valuation, and accuracy. What's your audit risk? The gains and losses are not properly calculated or accrued on hedging activity. What does EWC, the company, do to control that risk? They have strong controls in the Treasury Department to account for hedging activities. What do? Increase the number of hedging contracts tested. So let's look at those and make sure we emphasize contracts and currencies. Okay, so this is just an example of how we plan the audit. We're going to look at the business objectives and strategy of the company, what kind of business risk is associated with it, what kind of accounts are involved, what's the audit risk associated, what's the control to prevent the business risk, And then what kind of plan do we come up with? So if there's good controls, the audit testing could probably be less or lower. If there's bad controls, we want to increase our audit testing in the plan. Okay, so what kind of steps are there? What's the responsibility of the team? Well, supervision of the audit is conducted by the engagement partner and other supervisory members. So they inform the team members of their responsibilities, because remember, an audit is always a team. Direct engagement team members to identify and communicate audit issues, and then review the work of the engagement team members. So usually the partner is the last one to sign off. Supervisor is reviewing the detail work and collecting problems. Now, when we're conducting an audit, there's different types of audit tests that are done. The first are risk assessment procedures. These are done really to get a general understanding of the entity and its environment. Then there's test of controls. These are directed toward evaluating the effectiveness of the internal controls. So, are they good internal controls written down on paper? And not only that, are they operating? Are people actually following them? So we test that. And in a public company, we're required to. Private company, we're not required to, but we still do it. Substantive procedures, then, are used to detect material misstatement in a type of transaction, an account balance itself, or disclosures. So that's where our typical misstatement could occur, and that's what we're looking for and during these procedures. So tests of controls. Some typical types of test of controls are, first of all, inquiry. What do you do? How do you pay paychecks? How do you determine payroll? How do you account for inventory? Give me the step-by-step. Then watch. See if it's actually happening that way. Reperform it. Okay? Do walkthroughs. You trace a transaction from its origination all the way to the financial statements. Okay? And inspection. So that's what an auditor is doing during the tests of controls. Show me what you do. Now let me watch and see you do it. I want to see this happening. One type of test. Example of internal controls and test of controls. Again, create a separation of duties between the shipping function and the people putting the orders in and billing. So what happens? The credit department personnel are the initial sales orders. They create initial sales and credit approval. The billing department personnel account for the numerical sequence of sales invoices. They agree sales invoice to shipping document and customer orders. Okay, so that's an internal control over basically the order entry and billing function. Shipping and the order entry and billing. Now, that's what happens. We feel it's a good internal control. Let's observe and evaluate whether shipping personnel have access to the order entry or billing activities. If they do, then it's failed as an internal control. We can't rely on it. We should inspect a sample of the sales orders to see, is there a presence of initials from the credit department personnel saying it's okay for us to sell to them? Are they pre-numbered? We should inquire the billing department personnel about missing sales numbers. Are they all there? We should recompute the information on a sample of sales invoices. All of these things test those controls they told us about. And that's what you're doing during this phase of the audit. And really you're doing test of controls and substantive tests simultaneously. What are substantive procedures? Two major types, test of details. So now we're looking at the transactions themselves. Tests for errors or fraud in individual transactions, account balances, and disclosures. We also perform, and this was the case that I said don't worry about number 3 because it got a little too hairy with the analytical procedures. But we do this usually at the beginning and the end of an audit. I know I did. Analytical procedures. What do we do? Think back to intermediate accounting, accounting 101. You used ratio analysis where you did maybe 10 or 15 different financial ratios, current ratio, accounts receivable turnover, inventory turnover, profit margin, earnings per share, price earnings ratio, all those different ratios. Well, you do them again in the audit and you compare. You look for relationships among financial and non-financial data to look for problem areas, things you need to look at in more detail, or things that no, this looks pretty good. It's pretty consistent from year to year to year. Or if this ratio is high, so should that ratio. Why isn't that one high? You're looking for relationships. So tests of controls, as we said, they're dual purpose tests and substantive tests of transactions. Substantive tests of transactions are when you're looking at specific transactions. Someone like, a check being written. And they're usually being done simultaneously. Okay, so that's just an introduction to these different types of tests. Control, risk, and substantive. I think we're good with that. Okay. So this takes us into our final area, materiality. Materiality and determining it. What is it? You learned it back in 101. They talked about it in intermediate accounting. The United States Supreme Court's interpretation of materiality is that a fact is material if there's a substantial likelihood that the fact would have been viewed by a reasonable investor as having significantly altered the total mix of information made available. What does that mean? I can't sit here and say $100,000 is material. To different types of companies, different size companies, different amounts are material. So it is not an absolute. It's not black or white. It determines our professional judgment. How do we determine it? Well, in an audit, remember, we're not saying our financial statements are free of all errors. No, or their financial statements, I should say. No, we're not saying that. What we're saying is, overall, they're fairly presented. So there might be errors, but it's not a huge dollar amount that would change people's minds about the financial statements. They would still have the same answer even with those errors. If the material, they wouldn't have the same answer. They would change their mind. So step 1, we want to determine overall, how much could these financial statements be off? What's the maximum number before someone would change their mind about them? Once we have that overall number, then we focus in on accounts. Well, how much could each account be off? Tolerable misstatement. And then in the third step, we reevaluate that based on our audit findings. And that's usually not done till the end of the audit. So in the beginning of the audit, we're looking at 1 and 2. How do we do that, right? Usually there's a quantitative base used for materiality, and it's usually, depending on who the auditor is, a percentage of income before taxes, income from continuing operations, a 3-year average of income. And we would do that if we have an off year. Like say your company that you're auditing has $100,000 in net income year 1, $100,000 in year 2, $400,000 in year 3. Well, that might be a little off. So we'll average those and use a percentage of that. Total assets could be a percentage of that, or net assets, or total revenues, or gross profit, or total equity. It all depends. The quantitative amounts may be adjusted lower for qualitative factors. Meaning, well, last year we found a lot of misstatements, and there was a material misstatement last year. Maybe we shouldn't use that high dollar amount we just calculated based on this year's net income or operating income. The business is just in an industry for a high risk of fraud. Maybe we should lower that materiality level, how much the financial statements could be off overall. If there's a potential for loan covenant violations with how the financial statements are, meaning if you're not familiar with a loan covenant, a bank assesses or includes a contract with a loan. It's really part of the contract, and it's a list of rules for the company borrowing the money, saying, if your current liabilities go above $2 million, you're violating this loan, and we could make you pay it all back to us. So it's a list of rules that the corporation has to follow. Well, could they be encouraged to misstate something due to these loan covenants? That could alter our materiality level. Is there a lot of market pressure for them to do well? Is the business environment very volatile? Is there a higher than normal risk of bankruptcy? So we're asking ourselves these questions as an auditor and saying, okay, normally we take about 5% of the net operations income. But if these kind of things are present or something else that makes you feel your materiality level should be lower, then it should be lowered. You're basing it on professional judgment, remember. So that's how we find overall. And your book does mention it's usually about 5% of income before taxes. That's a norm. But you may select something else. Tolerable misstatement says, okay, it's the amount allocated to an account or class of transaction. How much can my cash account be off? How much can my accounts receivable be off? Okay, that's tolerable. And usually, combined tolerable misstatement is generally greater than planning materiality. Because let's say you say 5% of, no, it's usually about 50%. 50% of materiality, my materiality level, that could be the misstatement in my account. So 50% of cash, 50% of accounts receivable, 50% of each balance you're taking now. When you add up all of those results of how much you can tolerate, it's going to be higher than your overall material misstatement. Well, why is that acceptable? Because not all your accounts are going to be misstated. And audits of individual accounts are conducted simultaneously. So if there's a problem in one, you'll be able to see a problem in another if one affects the other. So that's why we are okay with those tolerable misstatements by account added up being more than materiality. Okay, materiality is often a small fraction of the account being audited, and planned procedures will be sufficiently precise to identify significant misstatements. That's what I was just talking about. When errors are identified, additional testing is typically performed in that account and related accounts to feel more comfortable about it. So overall materiality serves as our safety net. Okay, so that's we can't let that misstatement to be above that. If we do, we could have a problem. We didn't conduct our audit correctly. Finally, in step 3, when the audit's done, so once we've gathered all of the evidence, now the auditor is going to say, okay, what mistakes did we find? Let's add them all up. Remember, materiality is the top number. We don't want it to be more than that. Tolerable misstatement is just saying that's how much an account can be off. So if your aggregate misstatements all added together from each account, and any misstatements from last year that were not fixed, okay, we take those and compare that aggregate misstatement to overall materiality. So let's say we're almost done here. So let's say you have cash. I'm just going to jot this down on my page, and if you have a pencil, you can jot down. You have cash that has a $100,000 balance. You have accounts receivable. We'll just use 2 accounts with $500,000. You've determined materiality to be $20,000. The most you want your overall misstatement to be is $20,000. Your tolerable misstatement for cash is 50% of $100,000 or $50,000 and 50% of accounts receivable or $250,000. Okay, those are much higher than your material misstatement. Now, just see something. Oh, I'm sorry. I did that wrong. I'm sorry. It's not 50% of each account. I don't know what I'm thinking. Sorry about that. It's 50% of materiality. So 50% of 20,000. So the most we would allow cash to be off is 1,000, and same with accounts receivable, 1,000. Well, if cash, we find out that there was some mistakes, and the cash account is off $6,000, we have to say to ourselves, we got to do more testing. We got to see, we've only found 6,000. We got to see if there's more. Okay, but let's say that 6,000 is what we found. That's above our tolerable misstatement. We did more testing because it was above our tolerable misstatement. And we'll talk about those kind of tests. Accounts receivable, there's nothing. So your total misstatement, let's say those are only 2 accounts, is less than your overall materiality of 20,000. So we could feel comfortable saying, that's what the last bullet point is saying, if the aggregate misstatement is less than materiality, the auditor can conclude that the financial statements are fairly presented. If you're still not comfortable, I don't know if I'd be comfortable with 6,000, you go to the client and say, you need to fix this, and then we'll fix the financial statements. Okay, but at this point, according to our testing, we're okay to say the financial statements are fairly presented. Now, and that when they say an adjustment, all you're going to do is say correct that $6,000, whether it has to be 6,000 more in there or 6,000 less. We need to figure out, and you will know what the mistake was. Here's a journal entry, fix it, and then we'll incorporate that into the financial statements so that it is a correct balance. It's not off by $6,000. Okay, so just an overall presentation on how we handle materiality, tolerable misstatement, and then at the end of determine, did we go above overall materiality? Was it less than it? Do we need adjustments? Will the client make the adjustments? And that's when we start talking about what kind of report then will be given on the audit based on the answers to those questions. Okay, so there's a great example in there using earthware. Take a look at it. It's showing you materiality, tolerable misstatement, and the overall evaluation at the end, just like I did, but using earthware. So that's the end of Chapter 3's discussion on audit planning, types of audit tests, and materiality. So whatever questions you have about this process, please post them out on the discussion board. And in the next chapter, the coming chapter, we will be going into how we assess risk in a business during an audit. Okay, so that's still in our planning the audit phase. You have to assess risk now. Okay, thanks.